Okay, so good night, Board of Directors. Tonight we will be talking about the second part of the analysis of Walgreens. This presentation was made by Alexandra Ayala, Luis Kobayashi, William Smith, and myself, Juan Vera. So, using the dividend discount model, evaluate the shares and compare them with the market. So, what we did in this part was comparing Walgreens' initial price with the market, but we also wanted to include the initial price from its direct competitors, which would be CVS Pharmacy, Walmart, and McKesson. So basically, for Walgreens, its last DPS was 1.87. Its price in stock market was 39.88, and for the first growth for the first year, we used a growth of 33%. For the second one, we used 30%. For the third one, we used 20%, and for the fourth one, we used a perpetual 5%, which we used in the rest of the companies too. So as we can see here, in Walgreens' initial price was 150.95, which would mean that Walgreens' share is highly undervalued, meaning that in the long term, the value should increase exponentially. This growth started to happen after the 2020s crisis, where the company had an awful performance. So it is during the current year that its market performance has been one of the highest of the Dow Jones index. Also, after McKesson, Walgreens has the lowest dividends per share in comparison with its direct competitors. And this could indicate different things, such as lower profitability over a fiscal period, um, financial health and current stability, long-term growth prospects, among many other things. So for the rest of companies, the growth rates were obtained from CNN Money Forecast, and we used the highest estimate for the first year, 20% for the second year, um, the average estimate for the third year, and a perpetual 5% for the rest of years. So comparing Walgreens with their direct competitors, we can say that CVS Pharmacy has a similar undervalued share of 68.3 in the market. This could make CVS the most similar competitors for Walgreens in the long term because the share will increase with time. Also, Walmart and McKesson have overvalued shares of 144.15 and 173.92. So this means that with time their value will decrease, but still they must be considered strong competitors due to their reach in the industry. So evaluate the company using the discounted cash flow method. So in this part, the invested working capital and capital expense were assumed to be non-existent due to the 2020's COVID-19 crisis. So the first growth percentage for Walgreens was obtained from different news sources like Barron's and the Street, and it in these sources it was stated that the company had an awful performance during 2020, being one of the lowest performers of the Dow Jones index. And in these sources, it stated that since 2021 started, the company had grown 23%, and it was expecting a 10% growth in what was left of the year. So the rest of the percentages were assumed for this exercise. So as we can see here, subtracting the debt or the liabilities from the enterprise value, which was 85,617.73 millions, we get a positive equity of 19,579.73 millions. So the equity is basically how much we pay for the shares, and the enterprise value compares and measures an accurate value of the company and determines whether it's undervalued or not.
Okay, so for the 13 point, it's about evaluating the company using two multiples methods. In this case, we use the first method, and in this part, we calculate the enterprise value divided by the EBITDA, and we have a result. Okay, so in this case, we choose three direct competitors of Walgreens that are explained here as CVS, Walmart, and McKesson. And so we extract this evaluating ratio, about these companies, and we compared with the industry. Also, we compare it with the multiple it has Walgreens. So we see that it's in the average, okay? And also this table means that the market price of the share is 19 times the earnings, okay? About the method we have here in the right part. Then evaluate the company using two multiples methods. Here we are using evaluating the company, obtaining the weighted EBITDA and the weighted earnings. So we calculate it and we obtain here the result. And that's the explanation for this is from this chart. We can see that there are two valuation methods: the weighted EBITDA and the weighted earnings. For the EBITDA, it shows negative equity. Okay. On the other hand, for the earnings, for this valuating method, it shows a good enterprise value, a positive one, and well, it's the result we obtain. It seems that the enterprise value by the weighted earnings, it's better than the weighted EBITDA. Next, for evaluating a company according to the market capitalization method, we see that we here establish the enterprise value, the liabilities, that is the same in every evaluated. So then we have the adjusted value, we extract the goodwill of the company, the accounts receivable, and then we have the enterprise value we just find. And then we use the liquidation price. We obtain the assets by the enterprise value we uh, obtain in the adjusted book value, and then some with the workers. We have to pay taxes and liabilities, and then the equity was positive also. Then we obtain the market capitalization, and we sum by the liabilities, and it result the enterprise value that is positive. So the market capitalization we obtain it from Yahoo Finance, and it's basically by multiplying the number of stocks and the price of the stocks, and then the result has a big difference between the one is estimated by the adjusted book value, because it seems very different, you see. Then these results show a positive enterprise value that is growing year by year. Unfortunately, the growth since 2017, it's very low. You see here are big margins, and then it just stopped. So okay. Well, the different answers in these evaluating methods is that in one side, it is analyzing multiple methods that shows the evaluation for the weighted EBITDA and the weighted earnings. The data we obtain is that the first one mentioned have a negative equity, and the first one about here. Then, on the other hand, the earnings method shows a high enterprise value when we obtain the weighted EBITDA and the weighted earnings. The second method that the market capitalization appears is that the enterprise value obtained an 110 110,000 million approximately, and in comparison with the first method it shows a slightly difference. And also it's important to say that in the first evaluating method, here in the multiple methods, it shows a positive enterprise value and determine that the value of all the shares are 19 times the earnings.
So, how can the company structure to avoid the situation what happened with GameStop in 2021? So, at the beginning of this year, 140% of the stock of the GameStop public float had been sold short, meaning some of the shorted shares had been relent and shorted again. So, what is exactly shorting a stock? Essentially means borrowing shares from a broker and selling them later with the agreement that you will return the shares later when the price falls. you buy back the shares and pocket the difference. But this shorting stock is risky because you never know what's going to happen in the market. The prices raises and the stock prices also raises. If the prices raises, you can lose a lot of money. So if the demand increase, the stock prices also increase. GameStop had a lot of mutual individuals investors, and they were dissatisfied with the current market structure that they had. Another problem for them was the lack of transparency. They will look at the regulatory reports that they call 605 and 606, and they were from 20 years ago. So what made this then the increase of the shares was that the pet supply side, Chewy, put a lot of money into GameStop, and then he added $3 billion in market value after new investor to head digital transformation, according to Forbes. This happened in March 8th of the beginning of this year. And this ended up adding 35% increase in stock shares and $3.4 billion market value for GameStop. So how is this compared to Walgreens? GameStop is in the technology, gaming, industry, and Walgreens is the medical industry. So they are from different industries, but the technology is always changing. For example, what happened with Blockbusters and Netflix. Blockbuster was the top of the top buy at the time, and now Netflix came into the market, and now I don't even think that Blockbuster exists in the market. So with the medical industry, it's always new. I guess now people can also buy online more than in the store, and that's what happened with the quarantine started. A lot of people start buying online because they couldn't go to the store physically. But we don't know what can happen into the industry of the medicine, so we always needs to be open to what the changes are going to be. So how does the company manage the current context? Walgreens in the situation of the COVID-19. Walgreens swing to a quarterly loss as coronavirus drives up cost, lower doctors visit, and shares falls, according to CNBC in July 2020. Walgreens said that their profits were squeezed by a shift in sales and low margin items, increased supply chain costs, and higher expenses for labor and store cleaning. The company business in the United Kingdom, for example, took a hit with a foot traffic in food UK stores dropping dramatically in April during the stay-at-home orders, so the quarantine. With these step losses, the global drugstore chain said that it could cut more than 4,000 jobs in UK business and shut 48 optical centers in the United Kingdom. The company raises their annual cost savings target in more than $2 billion by 2022. In the United States, on the other hand, in the third quarter had stronger sales and the next quarter, but the warming margins will be squeezed by the pandemic-related factors such as the increase of the home deliveries, online traffic skyrocket. A lot of people start buying a lot online. Sales went up 120% in May and also even more in June. The strong customer demand for vitamins and protective equipment like masks made these all sales increase for Walgreens. Kihoe, who is the executive of Walgreens, he said that that Walgreens remains a strong financial position. They have a free cash flow and the cost-saving program and a new business opportunities in the market. Is the company sustainable, and how can that be sustainable and profitable? We think that Walgreens, it is sustainable, but they can be more profitable. For example, Walgreens just announced another new investment. They are doing a deal with Village MD that will open doctor's offices in 500 to 700 US stores over the next 5 years. So this is a long-term situation. Also, the company said it anticipates adjusted earnings per share for the fiscal year between $4.65 to $4.75, including adverse COVID-19 impacts of an estimate of $1.03 and $1.14 per share. The estimates are based on the sales of June 2020, but any dramatic changes could throw that off. The company suspended share buybacks and increased its dividends by 2.2% according to the data of July 2020. As we can see here in the chart that we studied, the sales from 2019 to 2020, they increased from 136 to 139, and this is in $1 million, but the profit decreased 2,000 in $1 billion comparing to the 2019. What is this? Because as I mentioned before, the costs were more. They had to put more cost into the company, the cleaning, because COVID and many other expenses that related to COVID, now all the companies had to do, and they were not used to do that much, at least more often.
Okay, in the case of the potential MYA of Walgreens, Americans source Virgin to acquire Alliance healthcare business from Walgreens Boots Alliance for 6.5 billion. American Virgin's acquisition of Alliance will provide even greater support to pharmacy and pharmaceuticals around the world, an integrated solution for pharmaceutical manufacturers. Warren Bull's Alliance will be able to increase its focus on expanding its core retail pharmacy business, providing even greater healthcare offerings to patients and customers, and further accelerating its progress on its clear set of strategy priorities. No? Mm, Okay. And the possible financial derivative that apply to the company. The Walgreens company can benefit from using financial derivatives such as futures or forwards, since it's a pharmaceutical company. To the historical prices of drugs should be taken into account in the future purchases in the market, and have greater profits in future financial derivatives. Forward financial derivatives may be the most appropriate, since they can buy outside the market with their suppliers, agree on a price and amounts, and collect a warranty in the event of the fall of any of the parties. For example, in the case that that is a forward contract, and if everything lowers its price in the market because the low demand as a result of the worldwide mass vaccination, Walgreens may choose not fulfill that contract and pay the warranty, which cannot be done the standardized future financial derivatives, no? Because the forward works outside of the market, and it's good to choose them. And the conclusions and recommendations: Walgreens has a strong financial position during COVID-19. Their sales increased in 120%, basically related to demands from vitamins and masks. Walgreens has an important enterprise value showed by estimating the method of the weighted earnings that is higher than weighted EBITDA. As Walgreens stocks is undervalued, buying these stocks will result in a positive outcome, taking advantage of the gap. And the recommendations: they need to keep offering vaccinations, because that increase the demand of customers that enter to Walgreens, and also voice some things around them, and consider the evaluated the company with the weighted EBITDA and weighted earning, and also compare with other methods in order to have better indicators for investment decisions. Thanks for all.